What are you talking about? My credit score is over 740? Imagine being penalized for having excellent credit. Sounds absurd, right? Well, buckle up because we're about to delve into a shocking twist in homeownership that might just turn your understanding of financial fairness on its head. The American dream, that white picket fence fantasy, has always been synonymous with homeownership. However, a new federal policy aimed at closing the racial homeownership gap has thrown a curveball into this dream. Don't get us wrong, steps towards inclusivity are always a welcome sight. But the way this policy has been implemented has left many scratching their heads in confusion and concern. So, what exactly is this policy, and what kind of impact is it going to have? Well, in a nutshell, it simplifies homeownership for individuals with lower credit scores, those below 620, by reducing upfront fees. Sounds great, right? But here's the kicker. To balance this, the policy raises interest rates for all borrowers, effectively increasing costs for those with good credit, those above 740. Yes, you heard that right. Individuals being charged more for an almost perfect credit score. It's like being a straight A student and then being told you have to pay more for college because of your excellent grades. It's mind-boggling to say the least. And it's not just confusing, it also raises serious questions about fairness. This approach has left many feeling like they're being penalized for responsible financial behavior. While we can all agree that inclusivity is crucial, the design of this policy raises eyebrows when it comes to fairness and transparency. This policy might have unintended consequences. Increased overall interest rates might discourage credit improvement efforts, potentially hurting financial well-being in the long run. It's like a domino effect where the good guys end up losing. Are the goals of fairness and equity going amok, you might ask? Well, it's certainly a question worth pondering. Individuals being charged more for an almost perfect credit score. Now that's a twist. The ripple effects of this policy are not quite what you'd expect. The consequences of this policy are far-reaching and somewhat paradoxical. While the intention is to make homeownership more accessible to those with lower credit scores, it's inadvertently discouraging credit improvement efforts. Imagine this scenario. You've been diligent about your finances, maintaining a credit score above 740. You've paid your bills on time, avoided unnecessary debt, and now, when you're ready to buy a home, you're charged more for your mortgage. It's like being penalized for responsible financial behavior. It's like running a marathon, only to find the finish line keeps moving further away. This situation leads to a myriad of questions about fairness and transparency. Is it equitable to raise interest rates for all borrowers, thereby increasing costs for those with good credit? It's like telling a student who has studied hard and aced their exams that they now have to work harder because others didn't study as much. The balance seems to have tipped, and not in a favorable direction. Moreover, there's a danger of this policy creating a negative feedback loop. If individuals with lower credit scores are given easier access to homeownership, what's the incentive for improving one's credit? This could potentially lead to a long-term impact on their financial health. It's like giving a student an easy pass on an exam without ensuring they've understood the subject matter. It might help in the short term, but what about the long haul? And then there's the question of overall purchasing power. If a person opts to incur a few late charges here and there to secure a better mortgage rate, will this affect their ability to secure other forms of credit? When someone applies for homeowners insurance, their credit profile is reviewed, and rates may increase with a lower credit score. It's like a domino effect, where one decision impacts another, and not necessarily in a positive way. In the quest for fairness and equity, it feels like the scales have been tipped too far in the other direction. These implications are far-reaching, and the questions of fairness and transparency are valid. This policy is causing more than a few raised eyebrows and questions of fairness. The impact of this policy doesn't stop at homeownership. It's a domino effect, where one policy's impact trickles down to influence other financial aspects of your life, but the ripple effect doesn't end there. Let's talk about overall credit availability. Your credit score is like a financial passport, granting or denying you access to various forms of credit. It could be a credit card you're eyeing, or a personal loan you need for an unexpected expense. With a lower credit score, your creditworthiness takes a hit. This might make it more challenging to get credit approved, and if it does get approved, you could be looking at higher interest rates. And then there's the question of future financial decisions. What if you want to start a business, or perhaps you're considering a significant investment? Your credit score is a critical factor in these scenarios. A lower score could limit your options and make it harder for you to realize your financial dreams. So, you see, the policy's impact isn't confined to your mortgage rates. Each decision you make, each policy you navigate, has the potential to impact your financial journey in more ways than one. But remember, while the policy may have ruffled some feathers, it doesn't diminish the value of good credit. Good credit continues to be a key that unlocks doors to lower overall costs, enhanced flexibility, broader opportunities, and peace of mind. It seems like this new policy reach extends far beyond just the mortgage rates. In the midst of the turbulence stirred up by this new policy, it's crucial not to lose sight of the importance of maintaining a solid credit score. First off, lower overall costs. Even with the policy's higher upfront fees, good credit usually secures lower long-term interest rates. This can save you a significant amount in the long run. Imagine the amount you could save over the span of a 30-year mortgage. It's like having a golden parachute, providing a soft landing for your finances. A strong credit score opens doors to diverse loan options, repayment periods, and down payment requirements. It's like having a custom-tailored suit, catering to your specific financial needs and circumstances. Good credit is like having a trustworthy compass in the wilderness of financial decisions. It brings confidence and control, allowing you to navigate your financial future with certainty. It's the quiet assurance that you've got this, no matter what comes your way. So yes, the new policy has shaken things up. It's ignited debates and raised eyebrows. But amidst all the noise and confusion, remember this: good credit will always be a positive driver towards financial stability and success. With the implementation of this new policy, it's clear that the terrain of homeownership has shifted. Now, more than ever, it's vital to stay informed about the changes and how they might affect you, whether you're a first-time homeowner or a seasoned property investor. Don't let the new policy discourage you from striving for the best credit score you can achieve. Remember, knowledge is power. Stay informed, maintain your good credit, and speak to your lender if you are trying to refinance or purchase a home, and explore all options that are available to you.